Get to Bob Pisani with the Dow down 9, Disney adding about 35. Morning, Bob.
Morning, guys. Happy Friday. Week open 2-1, declining to advancing stocks, but we're off of the lows. It's sort of a reversal of the trends this week. So consumer staples, defensive, have been down this week. They're up. Energy is giving up a lot of the gains, unfortunately. Tech flat. Banks small, giving up of the gains. But boy, what a great week it's been for banks, because you got a 20 basis point move in the 10-year, and that's creating some very interesting rotation. A lot of theories about whether this is going to last. So you got banks up nicely this week, new highs in a lot of the regional banks, home builders getting hit, utilities are down. I don't know how far this is going to go with the yield changing, but it's got a lot of people talking about what's going on. So if you look at elsewhere what's going on here, we've seen ETF flows all into bond funds this year continuing, and people are astonished. We're 15% increase in the amount of money, assets under management for fixed income this year. Kind of flat for equities and ETFs, so people are still putting money. And the question is, are they going to stop doing that if we feel there's some kind of bottom in yields at this point? Some of the stock bulls are arguing this could provide a little fuel going into the end of the year if money goes out of bonds and into stocks. We have seen that this week. That's exactly what's been going on in terms of the flows. We all know what the long-term story is. Most of the time, we all agree bond yields are going to stay lower for longer. We got the aging population, lower yields in exchange for safety, policy uncertainty out there, and demand's outstripping supply globally for bonds, even at these low yields. So nobody's saying there's going to be a revolution, but we're just talking about what might happen going into the end of the year here. Alibaba, I know Jim and David were talking about it here. This is a very interesting to me for a simple reason. $10 billion on a secondary with a $490 billion market cap. They're going to be listing in Hong Kong. It's a secondary because they list here. That's a pretty small amount for a $490 billion market cap. And it raises questions about why are they listing with just $10 billion. A lot of people feel that they want to expand their ownership base. They've got 600 million users in China. You think they might be interested in owning Alibaba stock? I think so. That makes a lot of sense to me. Will Chinese investors value Alibaba higher than U.S. investors have been? It's trading at about 25 times forward earnings. They certainly don't need the cash. Maybe there's some hope out there that they'll get the stock price higher. There's some evidence to support this. If you take a look at Alibaba, they first started talking about this listing. It was kind of vague, but it was way back in May. It was right about here. And you can see Alibaba has been outperforming not only the U.S. market, but the Chinese market ever since that. And it's been particularly strong in the last few weeks as it's become clear that the listing is actually now very, very real. So I don't know. Maybe another theory is that they want a backstop in case China-U.S. relations go south and things really get bad. That's a little cynical, but that also may be playing into this. All I can tell you right now is a lot of interest over there and possibly getting into Alibaba. 25 times forward earnings. You know, guys, that's pretty modest for a company that's still growing, what, 40% a year right now?